I think one of the things that we try to hammer home is that this is going to be a cycle. I think the Fed raising rates and interest rates rising is going to raise the cost of capital. It slows down growth. Then you have a situation where you go into a normal slowdown. Now, the timing of that has been unclear. I think a lot of folks have been early, and at some point we're going to see a slowdown, and you're going to see correlations return to normal. And over the long term, you'll just see the cycle continue to work itself out.
Welcome to the Active Advisor Podcast, brought to you by Harbor Capital. Join us as we learn from pros who have helped thousands of investors live better lives. I'm Brian Moore, and I'll be chatting with some of the brightest minds in the financial advisory business, bringing you insights on practice management and investment research that works for advisors and their clients. Welcome to another episode of the Active Advisor Podcast. Joining me today, we're thrilled to have Komson Silapachai, CFA. Based out of Austin, Texas, Komson is currently a partner at Sage Advisory Services, an independent investment management firm known for its expertise in traditional fixed income, ESG, and global tactical ETF strategies. Before becoming a partner at Sage, Komson served as VP of Research and Portfolio Strategy, where he played a pivotal role in macro strategy, asset allocation, portfolio construction, and ESG considerations. Prior to Sage, Komson spent 9 years at the Teacher Retirement System of Texas as an investment manager in its asset allocation group. But Komson's interests also extend beyond finance. In his spare time, he's passionate about exploring Austin with his wife and daughter, volunteering with retired racing greyhounds, and he's also a mentor through Partnerships for Children, helping foster youth transition to adulthood. Welcome, Komson, and thank you for joining us.
Thanks for having me, Brian.
This one's a special for me because I know you personally, and believe I actually first met you when you were at Texas Teachers. So we've known each other.
Yeah, we go way back.
Got to ask, how about those Rangers? I know you're kind of a Dallas area sports fan.
No, I'm thrilled. I mean, anytime we can bring a championship in a major sport to Dallas, gives me a year of bragging rights. Even though I'm not a giant MLB fan, I'm more of a football, basketball guy, but. No, I love seeing it. I have a lot of friends from Houston, so that was a really nice W for us. So no, I'm thrilled about it.
Well, given that we know each other personally, I'm really looking forward to the different directions that today's podcast is going to take us. But traditionally here on the Active Advisor, we like to get things kicked off by asking each of our guests, what's the first memory you have related to money or investing?
I have a few. Well, you asked me the first memory, but I'll talk a little bit about, when I was a kid. I'm from Thailand, so I was born in Thailand, Bangkok, moved here when I was 7 years old. And I remember a few years after I moved here, my mom and my aunts were just like freaking out about the exchange rate, the Thai baht exchange rate, versus the dollar. Obviously like they may have had some, friends with, obviously in Thailand. So, purchasing power really went down. And I just remember that being like a point of stress for them and never put two and two together. But now like flash forward, a couple decades plus, that was during like the Asian financial crisis back in 98. So it's kind of interesting to like look back at your memories in different context. The other, more on the investing side, I was in economics class in high school, and we had an exercise where, we'd have to go in and like buy a stock, just to learn what it was and learn about investing. And at the time I didn't know anything about markets. But so I just like look for, the most interesting stock in the market at the time. And, the thing that was dominating headlines was WorldCom. So I just like was like, hey, the price is low. So it was like a penny stock at the time. So I just put in my entire like imaginary capital in that. And I think like I made like a 5X on it, in whatever the semester, because the penny stock went from like a quarter to like $1.20, it was something crazy like that. And, we took those snapshots at the perfect time. And so, no, it was like my version of being like a meme stock guy, but, 20 years before it became a thing.
I think that's really, though, kind of looking back where the meme stocks got kind of, started. I mean, I can remember going, I was totally a separate story, but I was purchasing a car in Minneapolis, and the salesman came up to me, "Oh, did you buy X?" And I'm like, "What? What stock are you talking about?" "Oh yeah, I'm an active trader." And you're like, "Oh, okay."
Oh man, when was that?
God, I mean, it was late '90s, early 2000s. Yeah.
So that was like just came off a bubble or in the bubble.
Yeah.
No, it's I do think like the most recent episode of, kind of this boom in personal investing really started like when all the brokerage houses dropped their fees to zero. They all went to that Robinhood method or Robinhood, like model. And so people could just trade frictionless. And so it became like a casino. You pump in a lot of stimulus and here we are. So no, it's been very interesting 4 years.
Well, now let's hit the fast forward button. Can you tell us a little bit more about your journey? Heard a little bit already, and guide us through the timeline of events that led you to your current role and the work you do today.
For sure. So, when I went to college, I didn't really know what I wanted to do, but I wanted to, do something that made a solid living in terms of a stable job, and I'd grown up playing a lot of games. I was a competitive player in a game called Magic the Gathering. It was like a card game. And so I really liked the strategy. I like kind of the, just the way that, I solved problems through developing a plan. And then there's an element of chance as well. So there was kind of something that interested me about Magic and other games like that, was kind of a similar thing for markets. And so in college, I just continued to lean into that. I went to Texas A&M, major in finance, and, joined all the clubs that, had to do with trading and investing. And so, would join like trading competitions and Forex trading, model portfolios, and just like playing around with my friends, and just read a lot of books, read as much as I could. Checking books out of the library about, investors, books like Market Wizards. One of my favorite books that really kind of influenced me is a book called When Genius Failed, which is a book about long-term capital management. And that was one of the first books I read about markets, and it really piqued my interest in just the whole space. But it was a fixed income, focused book. So that was kind of my start in that area. And so when I left college, it was really the eve of the financial crisis. And so we didn't have, a lot of options, especially coming out of Texas A&M. It wasn't a pipeline school to Wall Street. We definitely had folks that went, to kind of the bulge bracket firms, based in New York City and things like that right out of school. But obviously those opportunities, were more scarce than they were in the past, in the mid 2000s. And so I really lucked into a great opportunity to intern at, Texas Teachers in Austin. At the time, it was a huge pension fund that was undergoing a transformation. So brought in a new leader at the time, named Britt Harris. He was also a professor at Texas A&M. That's how I got to know him and got to interview and got the internship and there at Texas Teachers. And one of the best things about an institution like that is that you're a global investor in nearly every asset class, and you also can do it at scale. And so I was able to really explore the gamut of what institutional investing on a global basis looks like. And so when I graduated college, I stayed on in that role in the Asset Allocation group. And then after I joined that, Texas Teachers, 2 weeks later, Bear Stearns collapsed. So it was definitely a trial by fire in terms of, market volatility. I didn't understand the magnitude. To me, like it felt a somewhat normal, because I didn't have a normal. I just, 2007, summer of 2007 was when I interned. I started kind of on the eve of the financial crisis. So I just didn't know what was normal, was abnormal. But looking back on it, it was just like the most harrowing time in markets, in all of our careers. And so navigating that, seeing kind of, what we had to do to in terms of reorganizing the asset allocation in the midst of the GFC. I gained a ton of experience. Then, I moved over to trading where I met you, and, learned about how markets worked, not just from, more the theoretical side, but just where the rubber meets the road of how, buy side participants, brokerage firms, broker dealers, other types of buy side, the entire ecosystem, so to speak, learn how that worked, which was really enlightening. And then, really kind of over time just fell into fixed income, mainly kind of the rate side, and ended up on the asset allocation team, focusing on that. And then, from there, I really leaned into that knowledge. And then, Sage Advisory at the time was hiring, in 2016 was hiring a portfolio strategist, focusing on macro. And I thought it was a great fit. I knew a lot of the folks here. And so I moved over here, about 7 years ago, and it's been a great match, and been a great experience.
That's great. No, it's definitely, I kind of forgot that I guess you did really kind of start your career during the GFC, which for a lot of people, I think, who've come after, really haven't sensed, I guess, one of those seminal moments in the marketplace. So I'd really like to take that was your kind of beginning time. And that was kind of when you were drinking from the firehouse about the markets mentality. How has that kind of, I guess, chaos, has that lent any added value or any kind of added knowledge to kind of what are some of the areas and how you're looking at constructing portfolios and kind of looking at the big picture nowadays?
Yeah, I think, one of the benefits of going through that period, and I don't even call it a benefit, it's just, I think it's just a consequence of going through GFC and a post-GFC period, is that having started my career in 2008, I was really a child of this zero interest rate policy. So the operating system for investors, after the GFC was one of, huge kind of central bank intervention. So, whenever we had a slowdown, we had quantitative easing, rates were at zero, eventually at negative in some countries. And so that was kind of the normal course of action for us. Of that generation, now we're in a totally different period where we're really in uncharted territory. Not only are we at higher rates, people have seen higher rates before, but we're also trying to unwind this, situation where central banks and central governments have been a huge part of the markets. And I wouldn't even say unwind, we're just trying to rebalance it to a normal level. And so the operating system going forward is going to have to change. And so, I think how it's really affected me is just kind of, having to reorient some of the, thought processes that you had, in, the 10 years post GFC to today. But one of the benefits is that, during that post GFC period, everyone had to know, how the Fed operated, that reaction function, you got to know really what the tools were, and then how to interpret them correctly, and then also, at a second level, understand how the market would respond to it. I think that's a skill set that's really widely shared by market participants today, especially, folks that, are kind of managing a lot of money. But I think before GFC and even, in the 90s and 80s, it seemed like, it wasn't like, standard knowledge, for folks. It's a price of admission now. You have to know, what the Fed is doing. You have to know, how, a change in QE policy and, change in interest rates affect other asset classes. It's just a price of entry at this point. Whereas I don't think that was the case 25, 30 years ago. So that's my long-winded answer of kind of how it's kind of, affected me here.
No, I think that's good. I mean, it definitely is. I think, we were all back then thrust into that fire because I'd started just, a couple of years before that. And you're right. You didn't really kind of, it was kind of just, throw another couple of logs on the fire of knowledge and learning. And, you had to assimilate it pretty fast. And I think it helped change a lot of us who kind of started our careers around that time. transition this, so now you're at Sage and you're kind of, in your current role. What are some of the areas that Sage believes are cornerstones to solid portfolio construction, especially kind of in this changing, it seems like we're also kind of doing a little change now.
I think the cornerstones for us, and this kind of goes across all asset classes. So we have majority kind of fixed income strategies, but we also have multi-asset strategies, equity strategies, but ultimately really the pillars for us in terms of portfolio construction. The first thing is that we like to look at risk and, portfolio metrics from different dimensions. So I think it's really important to look at, not just the risk of your own portfolio, but, what is the tracking error to your benchmark, and then where are the risks coming from? So, not only, your weights, your differential in weights between your sectors and styles and, duration and credit and things like that, but also, break that down to another dimension of different factors. So things like, momentum, value, growth, and fixed income could be quality and things like that. And I think that's really important to know, kind of to view risk from all those different dimensions. And then from there, really having another view of your portfolio of when the risks break down. So I think that, a risk model works on average, but during black swan events, you want to have a situation, you want to have a portfolio that is, or you want your process to take into account, what would happen to your portfolio in tail events. And so we do a lot of work on scenario analysis, scenario testing, both on hypothetical scenarios as well as historical scenarios to see what our portfolio would look like when a lot of these, tracking error assumptions, when you have like a VAR shock, so to speak. And so that's really the first cornerstone, is to look at your risk from different dimensions. And the second one goes in hand what I said about scenario testing and tail risk, is just humility. I think ultimately, models are, I think there's a saying like all models are wrong, but some are useful. I think that's really something that we take to heart, because we're in a world where you're seeing, things that you can't model, really, come to bear every couple of years. I talked about the post-GFC period. I think unconventional central bank policy was one. Obviously, a pandemic is one. I think there's a lot of, in politics, there's an overlay of politics today, and there's just a lot of things that are just, you just can't model, and so I think we try to take into account, kind of the context of the markets in relation to, the inputs that our models are giving us, in terms of risk and things like that. And so those are really two things. It's looking at risk from different dimensions and having humility, and understanding that your models will be wrong, but, so using common sense to kind of, take the inputs from your models and use them in a proper way, but not have to, not treat it like dogma. And that's just our process.
But is there any personal thoughts you have that you'd like to add on regarding, structuring a multi-asset portfolio? I mean, I know Sage definitely, and you have a large input in that, but I know Sage is definitely kind of looking at things at all levels, say the 30,000 foot view, all the way down to the 1 foot view. But I'd love to hear if you have any personal thoughts on that as well.
Yeah, I think today it's, I think we're in kind of an interesting period, because pre-GFC, we had a higher interest rate period, obviously. Asset allocations from the largest institutions to just a normal retirement portfolio, had a much higher weight to traditional asset classes, because interest rates were high, such that you can earn a 7% return just using publicly traded asset classes. Obviously, the sophistication in markets have risen since then as well. But fast forward to, the zero rate regime, where, you're still trying to earn that 7%, whether it's in your retirement accounts or your pension plan, but now you're starting at a 0% treasury rate. And so that leads to more aggressive asset allocations, maybe even not even aggressive. You're taking more risk in different areas. Maybe you're taking more liquidity risk through private, alternatives and private markets. You're taking on, more leverage and things like that because you have to compensate for the fact that yields were at zero. So now fast forward to today, you're at 5% treasury yields or 4.5%, today, gyrates 50 basis points a week, but, let's call it 4 to 5%.
Yeah.
A lot of those the thinking that you had during the zero rate regime has to also shift. Does it go back to, just using all traditional asset classes and, your 60-40? I don't think so, but, you can't use the same playbook as you did to earn 7% in 2015 as you do today. And so I think for us, it's like when we're working with clients and thinking about structuring portfolios for the long term, at a 4%, 4.5% 10-year rate, you only have to earn, 2.5% of risk premium over that in order to, over time, in order to gain 7%. Back 10 years ago, it was, you had to earn, call it 5.5% over it. So you have to take on more risk premium. And so I think that, my personal belief is that, you're going to see a big shift into more traditional asset classes. I think fixed income is certainly going to have a bigger role in portfolios going forward, especially at these yield levels.
Now, I'd love to kind of touch on a few things that you mentioned, but I'd love to hear really you started to allude to and mention it, but what are some of the general tones of the conversations you're having with advisors, and are there any common themes? Obviously, just from listening to you, I think one of them would be kind of what is it we have to do to achieve that kind of target 7%. But that really forces a lot of people out of their comfort zone where they've been investing for the past 12, 13, 14 years. How are they struggling with, or are they struggling with that? And how are you working with them to solve it?
I think some of the concerns that, some of the concerns that folks have on the advisory side, really post-COVID, has been just the rate of inflation and its effect on, financial assets, particularly because, that's what we do, but really all facets of like someone's financial picture. But, in terms of financial assets, you're seeing correlations really break down. So, equities and bonds are moving in tandem. And, this year you're seeing a situation where, there's been a ton of bond issuance, rates have risen, banking stress. And so I think all of that is a consequence of, higher than trend inflation. It's been really persistent. The Fed has had to react, and, therefore you're not having portfolios behave the same. And I think a lot of advisors are scared, and a lot of investors, outside of, financial advisors, from the largest to the smallest investors, are afraid that this is going to be the state of things on a go-forward basis. And I think one of the things that, we try to hammer home is that, this is going to be a cycle. I think, the Fed raising rates and interest rates rising is going to, raise the cost of capital. It slows down growth. Then you have a situation where, you go into a normal slowdown. Now, the timing of that has been unclear. I think a lot of folks have been early, but at some point we're going to see a slowdown, and, you're going to see correlations return to normal. And over the long term, you'll just see the cycle, continue to work itself out. And so I think what we try to do is try to keep, the view very long term. Because when you're staring at, 2022 and the turmoil in financial assets, it will mess with your mind. It's very hard to see those types of losses, especially across all asset classes. But I think, you're at a higher yield level now. And I think, there's a lot of opportunities on a go forward basis, and saving is actually, it's a really kind of ripe environment for savers on a go forward basis. And so we're just trying to keep that view long term when we're talking to advisors.
Yeah, I like it. Yeah, I think it's funny as we're approaching year end too. It's always kind of one of those where, as portfolio managers, just people who are students of the markets, we always look back at at that was the beginning of 2023. Obviously, we came in kind of with a different expectations and a slightly different mindset. But as we're kind of approaching year end, hopefully a couple of weeks away from the market, giving all of us some time off. What in your opinion and kind of Sage's opinion does the next 6 months look like for the fixed income space, and kind of how are you going about working this into the perspective of the conversations you're having, but also positioning of the portfolios? I know you mentioned that you don't want to necessarily think short term, having those longer horizons. Is that really kind of the focal point, or I'm sure there's probably added things that you guys are positioning for? Do you see any different areas, that are advantageous?
Yeah, I mean, I think over the next 6 months, I do. I mean, that's like the $1 trillion question. It's
I know I kind of put you on the spot there. I apologize, but
it's fine.
It's one of those. I think we all kind of look back and, whether you're technical analysis or whatever, you're kind of looking back and you're going, okay, we hit here. I do agree with you. We're due for some sort of something. I don't know what it is to return us back to a normal cycle, or maybe we don't get one. I don't know. I'm kind of scratching my head at this point. If I had hair, I think I would have pulled it out. But I do think there's probably areas, that where if we are looking at 3 to 5 years out for advisors and clients, what are some of those that we believe in, that are going to be good places that we look back and kind of go, oh man, I should have held on to that, or should have added to it.
Yeah. Well, I mean, I think, ultimately the level of yields makes everything cheaper, especially if income generating assets. But, just to go back to the next 6 months, I mean, I think, we're in a period now where the expansion this year and the resilience this year in the U.S. economy and therefore, assets have really been largely due to, the stimulus programs during COVID era, and it's kind of working, and it's, kind of emergence and working its way through the system this year. There's been a massive kind of fiscal deficit in an expansion, which is very abnormal. And so that's really helped kind of counteract the Fed, QT program, the rate hikes of yesteryear, and then some this year. And going forward, you're not going to see that level of fiscal stimulus, we think. And so we're going to be in a period where you have liquidity withdrawal from central banks through continued quantitative tightening. You're going to have liquidity withdrawal from the federal government through issuance of bonds. You're going to have liquidity withdrawal through lower bank lending, and any type of lending, activity is really dropping off a cliff, obviously after, the regional bank crisis. And so you're seeing a drain on liquidity that could be used to like stimulate the economy or to be used for economic activity or investing activity. And so the next 6 months, we think we're going to see the effect of that. And so, how do you prepare for that? Obviously you have a long-term plan that you want to stick to, but if you do have flexibility, be a little bit more defensive on growth assets. So things like, equity beta, we're taking a little bit lower. We like bonds currently because we think that, the level of yields not only give us, if we do go into a slowdown, it should, bond prices should appreciate, but in a drawdown, you're not coming off of like a 1% 10-year, you're coming off a 5% 10-year. So that kind of self-healing period it's a lot quicker in terms of any drawdowns you may experience. Investment grade bonds, you're earning upwards of 6% in terms of yield. And so, I think that, that's kind of how we're positioned and messaging that to clients and in our kind of external notes as well.
I'm glad you mentioned external note, because I want to highlight that you are also the author of Sage's weekly market commentary, Notes from the Desk. So one of the things that I get whenever I write something internally, and I'm sure you get as well, is are there any specific tools, resources, or thought leaders that you rely on? What is it, that if you could share with us some of the things that you kind of focus on when you're constructing that note?
Well, I think it's a weekly note where we're really trying to just update our subscribers, our clients, about, kind of what we think is most interesting. And I think the difficulty in writing, especially in kind of our world, is keeping things succinct. It's easier to write a 40-page white paper, explaining like the ins and outs of mortgage-backed securities than to write a one-pager talking about, what they are, valuations, and what we see on a go-forward basis. Like, I find that so hard, so but ultimately how I go about it is, really lean on our team. We have, we're separated into we all work together and everyone, chips in on each sector, but, we have kind of subject matter experts on securitized corporate bonds, rates, macro equities. And so what we try and do is just try to glean out the most interesting thing for that week. So, obviously in the month of September, and really October, the biggest piece of news in fixed income was the rise in long-term interest rates. So we tried to address that. Last week, we also addressed, mortgage-backed securities, like I mentioned. So I worked with our mortgage portfolio manager on that. But, we leverage internal research. We use, some really good third-party research. And one area, one outfit that I like to kind of point out, Variant Perception, they're really solid in terms of independent research on a macro level, but they do go down into kind of sector level recommendations and research as well. But we run the gamut. We use the sell side research houses and ultimately cross-reference them with our view, and kind of just try and always, just for lack of a better word, use it again, like cross-reference to make sure that, we are sound in our reasoning for a particular position, for a particular view. We're looking at the right things. We're not missing anything. And obviously that is a pursuit, that lasts forever. And when you're operating in markets, so, we're always doing that. So the way we communicate within our investment team is, we have a team meeting every single day around the open, where we go around the horn. We talk about our market view and kind of any data points that have either added to it or detracted from it. Maybe there's an economic release that we want to talk about. Most days you're not really changing the view. It's really just constant re-underwriting. And if you think about it, it's kind of just like practice. It's just getting reps on and just always staying in sync. And then we have our investment committee meetings that happens every couple of weeks, where we're really trying to, set a firm-wide view on the economy, on policy, on valuations, on the larger strategy of the firm, of which the portfolio team will then express in all of our strategies. But ultimately, I think the key for us is just that constant communication, informed by some of those sources I mentioned.
Awesome. Well, thank you very much. I know we could continue this forever. At least I could. I always love picking your brain, but we are going to wrap it up here. But I get to ask you one final question. We understand that every financial professional has their own take on certain concepts within the industry. And at Harbor, we're firm believers in active management. That being said, in a previous conversation we had, you mentioned that you believe active and passive are sort of made up categories and that there is more of a psychology involved. Would love to hear a little bit more about this.
Yeah, I think with money in general and investing, there's always decisions that have to be made. And I think, passive investing versus active investing is sometimes used more, and simplified to death. And it really is not specific enough. Sometimes you can be a passive investor, but choose the wrong index. So there's the decision there to kind of choose the vehicle, the index that you're invested in. Active, there's different levels of active. There's, picking securities, there's factors, and different levels of turnover. You can have active risk. So I think for active versus passive, you're always making a decision as an investor. If you're starting your portfolio and you set a passive portfolio to earn 7%, and like I mentioned before in 2015 versus today, that's a decision. Your portfolio composition will probably look different. And whether you choose to rebalance that or not is really up to you and your advisor and consultant and things like that. But I think there's just always a decision to be made. And I think especially when it comes to psychology, you want to pick a style that allows you to stay the course, for as long as you possibly can. So, if you're a passive investor, but you have the wrong risk profile, during a huge drawdown, it could induce more pain than you'd like. Maybe causes some sort of behavior, maybe selling at a wrong point, things like that. So to me, it's a little deeper than that, and it's like indexed versus enhanced index. There's more specificity that I think could be applied to this area. And I know it's like a lot of discussion just takes place in the headlines and things like that, and no one is just like active versus passive, and that's everything. But to me, sometimes I'm like, what do you mean by passive? Because just like something that's more systematic that you can just set it and forget it could also still be active, and in terms of the way it's constructed, and does it match up with the client's objectives? Does it help achieve someone's financial goals, and does it allow them to stay the course? I think those are really important things to consider.
I think that's a great point. I think when you're choosing something, even maybe it's listed as passive, the stocks within that indice they aren't passive. And so as they're moving, you really kind of do want to have that factor into your decision making for the longer term. And we're going to end it there, but I would love to have you on maybe again in 2024. Last but not least, how can people find you? What is your social and what's your website?
Yeah, you can find me on LinkedIn. That's my main kind of social media platform. Put out commentary. Again, really help write that weekly note for Sage, and then you can find Sage Advisory at our website, sageadvisory.com. And we also, put out some great kind of decks on a monthly basis. We really try and put our views out there really across markets, fixed income, macro, ESG. And so I highly recommend, if anyone wants to follow us, just subscribe to our newsletters. And, I think it's a lot of really good information.
Oh, I agree. And you should definitely hit the subscribe button. So now we're going on to my favorite part of the Active Advisor, which is 60 Seconds with Komson. Let me know when you're ready, sir.
Okay, I'm ready.
Nickname?
Benz.
Hobby?
Martial arts.
Hidden talent?
I can cook really well.
Favorite podcast?
I love audiobooks.
Favorite Texas sports team?
Dallas Mavericks, for sure.
Best part of your job?
Best part of my job is that it's always changing, and it's kind of a combination of a lot of different disciplines like math, econ, history, psychology, and there's an element of like human nature on top of all that.
Profession, if you weren't in finance?
Originally, I wanted to be a comedic writer.
What advice would you give to your younger self?
Be present in the moment.
Most recent book you finished?
Finding Ultra.
Celebrity, living or dead, you'd most want to have dinner with?
Any U.S. president.
Favorite way to get active?
I mentioned before, I love martial arts. I've done like all different types of martial arts, like Muay Thai, boxing, I'm doing capoeira, and just running, just always doing something.
Whether you're a seasoned advisor or just getting started, the Active Advisor, brought to you by Harbor Capital, offers professional insights for the financial advisor community. Visit us at harborcapital.com to learn more. And don't forget to subscribe to the Active Advisor on Apple, Spotify, Google Podcasts, or wherever you listen to podcasts to stay up to date on investment trends, tried and tested research methods, and what your industry peers are up to. From all of us at Harbor Capital, thanks for tuning in.
And now for important disclosures. This material is for informational purposes and is not intended to be relied upon as a forecast, research, or investment advice, and is not a recommendation, offer, or solicitation to buy or sell any securities or adopt any investment strategy. The opinions expressed are as of 10th of November 2023. and are subject to change. The opinions expressed by the speakers do not necessarily represent the views of Harbour Capital Advisors Inc. The information and opinions contained in this material are derived from proprietary and non-proprietary sources deemed by Harbour Capital Advisors Inc. to be reliable and are not necessarily all-inclusive and are not guaranteed as to accuracy. This material may contain forward-looking information that is not purely historical in nature. Such information may include, among other things, projections and forecasts. There is no guarantee that any of these views will come to pass. This material may not be representative of the experience of other individuals. Reliance upon information in this material is at the sole discretion of the viewer. This material is not legal, tax, or accounting advice. Please consult with a qualified professional for this type of advice. Investing involves risk, including the risk of loss. Specific companies and issuers are mentioned for educational purposes only and should not be deemed a recommendation to buy or sell any securities. Any companies mentioned do not necessarily represent current or future holdings of any investment products. Harbour Capital Advisors Inc. does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. This material is prepared by Harbour Capital Advisors Inc. Harbour Capital Advisors Inc. is not affiliated with
Sage Advisory Services.
All trademarks or product names mentioned herein are the property of their respective owners. Copyright 2023 Harbour Capital Advisors Inc. All rights reserved.